Nope.
No intro music yet, so it's
No intro music.
I gotta.
Are we live now? We are. Hey, Trent. Good morning. Trent's still back there working, trying to get everything going. So we started this last week and don't have intro music made yet, but we will, and it's going to be awesome.
What do they call it on Saturday Live? It's like a cold opening or
Cold opening.
yeah, cold open.
Cold open.
Yeah,
I've never heard that term. So that's when they just start.
Just go straight into a sketch.
Cold start. That's it.
Cold start.
I like it.
Okay. Yeah, my old truck sometimes does a cold start, and I got to let it warm up before we drive it. So we were just talking Halloween stuff over here, and Bryan did not make it through Dahmer, the show, right? Being Halloween, we can talk about this kind of stuff.
Yeah, I mean, it's relevant.
Yeah. So I started with a one-liner from my stepson. He comes up to me this weekend and says, "Hey, did you know that ice cubes swim in their own blood, in a pool of their own blood?" And I'm like, "Wow, dude, you're 9." Yeah, that's dark.
Way to go, buddy.
Dark. So anyway, love you, pal. That's a good one. So got my friend Bryan Nale here, Primis Mortgage, and the guy that I trust the most whenever it comes to all this crazy mortgage interest rate rodeo that we're going through right now.
You intentionally had a mortgage guy on Halloween, right? That's
yes.
Totally by design.
Hey, if I really wanted to be scary, though, we'd have the underwriter with us. You know what I mean? Or maybe the appraiser. But no, we've got the mortgage guy. It's been a year, man.
I mean, at the beginning of the year, we all thought, hey, maybe you will see 5% by the end of the year.
Mm-hmm. I said 6.
Yeah, and we saw 5% in like April.
And we skipped the 4s.
Didn't even bother with the 4s.
No, it was like 3.75, 5.25. What?
Wait, what? I don't understand.
There's a whole other digit in there. Come on. Yeah, it was pretty crazy. And, you know, I always liked I used to teach economics, and I always liked the psychology of it, right? So when stuff goes crazy, and it does. I mean, whether it's gas prices or it's interest rates or it's housing prices or what, there's always something going bananas, right? And the way people react when that happens has always been just fascinating to me. And this is definitely not been a letdown as far as on the fascinating. Let's look back at this in 5 years and all laugh. Kind of.
There'll be some laughing, you think?
Yeah, in 5 years. Yeah, let's hope, right? And I mean, I kind of just walk around all the time with questions, that go through my head. Well, what happens if, and why would they, and what are people going to do when those kinds of questions?
So you talk about the psychology of it. It seems to me like every time we've had one of those big stair steps, like we step from the 3s almost directly through the 4s into the 5s, it's like, well, things just grind to a halt, like immediately.
Everybody pauses.
Everybody stops.
Mm-hmm.
About 2 weeks go by, and then like applications start to come back.
Mm-hmm.
And it's like people just like, okay, well, this is where we're here. This is where we're at now. And I think it's going to keep going. So I probably want to go ahead and do something sooner rather than later. And so at a certain point, we're going to get to a stair step, and I don't think that'll be the case. I think that it will kind of stagnate for a little bit longer period of time. And then the question that I'm sure, the $1 million question is, where's that step?
Yeah. What's that number?
Where do we get to that point where it's like, okay, everything's really stopped now? And the psychology behind that is going to be interesting to watch unfold.
Yeah, and it's what's really interesting about that is everybody's got their own. We talked about this a little bit last week. They've got their own barometer of what that is, right? I'm pausing right now. I'm going to wait and see what happens when, and it could be midterm elections. It could be when rates hit this number on the high side, or when they drop back to this number on the low side, or when they break ground on that parcel of land across the street from me, or who knows, right? Everybody's kind of got their own thing, and a lot of it I think has to do with who you listen to.
Yeah.
And what your specific they are saying.
and you can find that echo chamber. You know, if you want to, man, if you're not analyzing data from both sides, and a lot of times we talk about like Republicans and Democrats, but in the financial markets, there's bulls and there's bears.
Mm-hmm.
And if you're not analyzing data from both of those and really understanding what you think is going to happen and using that to make your own logical decision on how you want to play this market, then you're doing yourself a disservice. You really, really, really don't need to just get lost in that echo chamber of, oh, doomsday, or, oh, everything's going to be all right. Whichever side you're reading, read the other side too, and try to do the best you can.
And not just read
it.
Yeah. And always look for sensational words, right? When you find the sensational words, you go, okay, there's a motivation behind this. Right. So I want to find people that have some sound, logical reason as to why they're saying what they're saying.
Yeah.
And then I kind of decipher through that. The reality of it is I could have 500 experts sit in your seat right there, and all of them would have a little bit of a different answer on what's going to happen over the course of the next 6 months to a year.
Yeah.
Right. And the reality is a couple of them will be right accidentally.
No, that's so true.
Do you know what I mean?
Yeah.
No one, if they say, I know exactly what's going to happen, this, and this, they're wrong.
Yeah. I mean, you can have a bombing in Yemen that affects the oil markets, which in turn affects the bonds markets, which affects mortgage-backed securities, and everything's so global and intertwined now that it's not like it used to be, where you really were just trading fundamental securities of, the risk of a mortgage and how those are pulled together. Now you're looking at, everything's just like you said, it's just intertwined and connected.
Yeah. Globally.
So
something in Yemen or China or Russia or, Ireland could.
Yeah, that's a good point.
Have ripple effects.
It can be in England. And in England, a couple of weeks ago, something, we'll spare the details, but something really scary in the bond market happened, and mortgage rates shot through the roof. And then England was like, oh man, we just accidentally created a huge, huge story, and let's unwind what we said. And then by Wednesday, rates had just kind of reverted back to where they were at the start of the week.
And I think that's what freaks people out the most. It's not necessarily, okay, rates are sitting at whatever, 7.25 today, or 7.5 or 6.75. It doesn't matter, right? Rates are sitting at this today. That doesn't matter. I mean, it does, but it doesn't. What really matters is, did they fluctuate, 3 points over the last, 2.5 weeks?
Yeah.
Were they 5 and then they, jumped up to 5.5 and then they went to 6 something and then they dropped back down. And that's what freaks people out, because that creates this, I guess, idea or this plan that they're going to somehow time the market out.
Yeah.
Right.
Well, there's so much volatility and that comes with a lot of risk. And it's like trying to be a day trader. You might hit a home run or you might miss. And at the end of the day, you're buying a house. It's a big investment. It's a big, you're signing a loan document to repay a large sum of money, and you need to be comfortable with what that payment's going to be at the time that you're doing it. And that's where I think you got to get the right advice and kind of know what your game plan is. And I know we're going to talk about some of these things, but how are points going to work for you or against you in this? What's the market telling you think's going to happen, but also what do you think's going to happen, and which way do you want to bet this?
Well, and then what's your tolerances?
Right.
Let's pretend I'm wrong by 50%, or I'm wrong by 10%, or I'm wrong by whatever. What are my tolerances? If I'm comfortable in this payment is at $1,500 at I don't know, 6.5%. Okay, cool. I'm comfortable there. Well, what if it goes up by 200? Am I still comfortable? What if it goes down by 200? Do I want to buy that house, or do I want to look at something more expensive?
Yeah.
Right. And so you kind of work through some of that.
Yeah.
There's also some things in place, and this is, I really wanted to talk about some of these because for the most part, the mortgage industry tries to be somewhat proactive. That's hard, but they definitely are at least the good ones are fairly swiftly reactive in offering some products and some services that will help folks kind of navigate some of this stuff. So one of the things that I've always I know that it happens. I'm just not sure what the details usually are. What is a float down? So if I lock a rate today, right, and it's 7.25, okay, and we do have volatility over the next 3 weeks that it takes for us to get, to where we're clear to close. You can float the rate. Is that correct?
Yeah, most lenders will have a float down provision built in.
So what is that?
So when you lock in a rate, and understand two things are happening. You're committing to the bank and your lender that's the rate you're going to pay. And if the market improves and you maybe a slight amount, and you're still locked in. But that's a two-way street. And the other side of it is that the lender is locked into honoring that rate for you,
even if it goes
even
up.
if rates go up. And so to do that and do it well, lenders will hedge. And so that's why when there's a cost to the lender to float that rate down, but at the same time, the lender wants to close your loan. They don't want you to, if rates have improved significantly, doesn't make any sense.
That can happen sometimes in a short period of time.
In this market with this volatility, it absolutely can. So you don't want to go through the expense of originating and underwriting and processing that loan and then lose it at the last minute because rates have dropped. So that's where the float down provision will come into play. And it usually needs to be a significant advantage, a significant difference. But
what's significant in your world?
About a half a point.
Okay.
Yeah. So if it's moved about a half a point, you should be able to.
So I'm locked at 7.25. It goes to 6.75. We will start talking about
what that rate renegotiation looks like.
Okay. Does it typically cost to do that?
Typically, it depends. It can be built into the pricing. So then that's one of the things with lending that there's. Sometimes we've got these loan estimates and CDs and all this transparency and stuff, but a lot of fees are just built into the base rate. And so, if there's a cost to that lock renegotiation, most of the time it's not going to be an out-of-pocket cost. It's just going to be built into the rate. So if the market's improved from 6.25 or 7.25 to 6.75, instead of renegotiating to 6.75, you might renegotiate to 6.875.
And then that extra 0.1 covers the
fees for the relock.
Got it. Okay. Gotcha. Now there's another product. I've been seeing this popping up. I know you guys are about to roll this out as well. There's another product called a 2-1 buy down.
That's right.
Tell me what that is.
So with a 2-1 buy down, in essence, you're paying the interest up front for the first 2 years and the spread between the promotional rate and then the final rate. So if the final rate, if the actual rate, the time that you lock is 7.25, then for the first year you'd pay 5.25, the second year 6.25, and then that third year, the third anniversary of the closing, it would go up to the full rate of 7.25. And so what happens here is you're paying at closing all of that interest up front, the gap between
for those 2 years,
right? So it really only makes sense if you have somebody else that's paying that for you. But if that really helps you get comfortable at the payment that you're looking at, then and the seller's going to pay it for you, then
essentially seller paid closing costs.
Exactly. Mm-hmm. And it can be a builder incentive. It can be a seller incentive. I've had a lot of realtors that have asked me for information about like what it would look like if to make it more attractive to help sell the house, because listing agents now are working their listings and they're not just putting a sign in the yard and putting on real tracks and entertaining offers. You have to market the house. And so to do that, some sort of seller concession can be an incentive. So that's a great one. Now, if you're the home buyer, you're betting on one of two things. You're betting on either being able to have your income increase so that you're more comfortable at the elevated payment.
It's 2 years down the road.
That's going to come 2 years down the road. It's like it's like an arm, but it's capped and it's where it's going to go. And when it's going
to happen.
So you're betting on being comfortable with that payment at that time, or you're betting on sometime in the next 2 years being able to refinance it into a lower fixed rate mortgage.
So a substantial enough drop that it makes sense to incur the cost of refinancing.
Right. Because otherwise, if you don't think that either one of those two things is going to happen, if you don't think that, hey,
it's not a good product,
I'll be more comfortable with that payment in 2 years because I'm in residency and I'm going to be a doctor then, I'm going to make a lot more money. Or there's something that's that's going to change in your lifestyle where your income is going to be higher. And you want to go ahead and get that house at today's price instead of the price for 2 years down the road. You can do this and move in. Or if you think that the rate's going to improve so you can do the refinance, you can go ahead and get in. But if you don't think that either of those things is going to happen, then you'd be better off using that money
to actually pay your closing costs.
Your money or using the seller's concession to not just pay your closing costs, but maybe buy the rate down on a permanent basis. So instead of going from 7.25 to to 5.25, you're going to buy it down on a permanent basis to get it, where it's going to be 6.5 for the life of the loan.
Gotcha. Which one is typically less expensive of a buy down? The 2-in-1, I would assume, is less expensive.
Well, the 2-in-1, you're just paying the difference in interest. So it's not, if that interest expense over those first 2 years is $10,000, then you're paying $10,000.
Where a rate buy down, there's a costing associated to that. I got you. Okay. So here's the thing, like my brain is going about 25,000 miles an hour right now. So that is definitely something when you sit down with your mortgage lender, you hope that they are knowledgeable about that and can run all of the scenarios. And you kind of got to have some idea of kind of a 1 year, a 2 year, a 3 year, and a 5 year game plan on what your future would look like. Now, obviously that's subject to change, but you need at least some kind of an idea.
Some kind of, you need to understand what your goals are. And you and I were talking last week, and I was showing you some scenarios, and you're like, I was like, which one of these would you choose? And you were very clear with which one you'd take, and framing that conversation about conversations that we'd have with clients. And you said it's just important that we listen, that we understand what their motivations are. Are they more concerned about the payment? Or are they more concerned about the cost of points? Are they more concerned about equity in their home versus maybe using money? And instead of putting an extra down payment in there, using an extra, let's say you've got $10,000 to work with. And was it better for you to pay that $10,000 down in principal on the house, or better to pay some money to buy some points? And all of these factors are going to come into play. Like, hey, why pay the points if you think you're going to refinance it in 2 years when rates are lower? Because you think rates will be lower. I'm not saying that rates will be lower, but if you think that they will be.
Well, and then if you believe that we are on the precipice of some type of a bubble or a price pullback or whatever, you don't want to put the $10,000 necessarily on principal either.
Well, you may feel like, hey, we're possibly going into a recession, and my job's one where I don't have a ton of security. Maybe I'd rather have that $10,000 in a savings account to give myself some liquidity in case this recession ends up hurting us financially.
Right. Yeah. All kinds of fun decisions. This is why you need a good advisor and somebody and it's not even an advisor. You need somebody to ask the right questions. That's what a good advisor does. Ask the right questions to get you to think about what if, and not just what if, but what are you comfortable with? What pushes that comfort button for you? Because that's I'm probably different than you, and you're probably different than Trent, and Trent's probably different from that guy right there. Not you. Yes, you, that guy.
And in some cases, you might have a couple who don't have the same thought process there. And so now it's really complicated.
Yeah. Fine.
One side of the couple may want to do this, and the other person in the couple may want to have, take a more conservative approach.
Yeah.
So it's so many ways to.
So do you get into marriage counseling in those scenarios?
I try to stay out of that.
Yeah.
But, it's like I say, and when I host your other show or sponsor the show, and that thing, I say there's a lot of different ways to navigate financing a home, and having a trusted advisor, somebody that you can pick up the phone and bat ideas around with, somebody that's going to ask you the right questions and listen to your responses to give good advice. And at the end of the day, I feel like what my role is to say, here's a couple of options. There's advantages to this. Here's the downsides, the risks. Here's the advantages to this, and here's the risks with this. And what questions have you got? And then let's talk through this.
And maybe we scrap all of that and we find a different answer altogether.
And at the end of the day, it's your decision.
Yeah, that's right. All right. So one of the things that that has been really intriguing to me, and we started talking about this a little bit last week, but it just got me thinking, and I've actually somehow I've had this conversation with a couple of folks this week, and it's interesting. So right now we're on a national level, we're at a period of inflation, and the monetary policy at a time of inflation is to raise interest rates, make money more expensive, right? So therefore it pulls the supply of money back in the overall market. We're not just talking housing here, we're talking overall, right? So that's the monetary policy. Inflation happens, it gets out of control. We raise interest rates, the Fed raises interest rates, pulls money supply back. Pulling money supply back makes the value of the dollar go up, which makes the cost of things go down.
Right.
Okay. Simple economics. There you go. Welcome to my old high school economics class that I used to teach.
You need a whiteboard back here.
I do. Yeah. Just a bunch of arrows, blue and red and a green equilibrium. So my question is that one of the things that I've started hearing over the last week is some people are predicting that rates will continue to go up a little bit more this year. We could end the year at, somewhere in the upper 7s to 8s, even possibly, right? Or, somewhere thereabouts. And it'll stay that way for a little while. And then end of next year, we're going to start seeing rates table off and come back down. And that's the prediction that I've heard from several unrelated sources. My question is, and you may or may not know this, but if raising rates curbs inflation and we raise the rates to do that and inflation starts to deflate a little bit, why would we immediately lower rates to spur on activity that would potentially immediately spark that inflation back up?
We've been there and done that, right?
Yeah, like that was the early 80s.
That's what happened. And the Volcker administration, that's exactly what they did. And if you listen to what the Fed is saying and reading their minutes and their commentary, that's not their plan.
So why are people saying that? Because here's the problem. If you say that, back to what we were talking about, that volatility, that planting, hey, this is going to happen. At the end of the year next year, they're just going to lower rates again.
Right. Well, and I've heard so many people say, marry the house, date the rate. Well, if you buy it like while we were on the way up, and you bought a house at 5, thinking, hey, maybe I'll refinance it into the 3s at some point.
Mm-hmm.
Well, now we've gone to 7. There's no guarantee that when rates do come down, they're going to go back below the 5 that you bought it at. So you better be comfortable with that payment.
Mm-hmm.
So that, I just wanted to make sure that I worked that in to this conversation. But to answer or to speak to your question, mortgage rates aren't necessarily tied directly to what the Federal Reserve monetary policy is.
Mm-hmm.
And there's other things that can drive mortgage rates. So what I'm listening to, or what I would advise anybody who is reading that material that's saying that rates are going to start to come back down next year, pay attention to why
and which rates we're talking about.
Which rates you're talking about. If it's mortgage rates, maybe mortgage rates will start to come down in advance of the Fed's monetary policy and where the Federal Reserve is setting its rates, because it's going to raise, like, we're expecting 125 basis points in rates in the Federal Reserve rate to go up before the end of this year.
Mm-hmm.
50 and 75 basis point hikes is what they've said that they think they're going to do.
And
so that's going to affect your credit cards, car loans, the short-term revolving debts. That's what's going to directly affect.
Correct.
Now, sometimes they may, depending on what they say in their minutes, mortgage rates may move in an opposite direction of the Federal Reserve's, the Fed funds rate,
based on the news itself. Right. But overall, they do tend to track in similar directions, at least.
And you can really follow the 10-year Treasury and look at that and just kind of and see how that's moving to get an idea of where mortgage rates are going. But you have to be really good at reading charts and predicting the future. And I can say all these things, but actually looking at that and knowing where it's going to go, that's something I continue to try to educate myself on.
Mm-hmm. Yeah. Well, and a lot of that's just experience, man. Yeah. And it's just, we got to get through several cycles before you become a sage.
Well, and you can look back and look at cycles, but that doesn't have any bearing on what's going to happen next.
Correct. So, again, back to your bombing in Yemen or whatever.
And when you said you could have 100 experts, like, hey, you could have 500 experts in here that are well-versed and know how to read charts, and they can look and see the head and shoulders and the, whatever kind of, however you want to describe this chart. That doesn't guarantee what it's going to do next.
Not at all. So something else that's been really interesting with the market kind of softening here of late, we're starting to see some financing options again that quite frankly haven't really been, at least in Rutherford County, have not been. I mean, they've almost been non-existent in a lot of ways. So your THDA stuff, even to some extent, your standard FHA, certainly not gotten as much traction as a conventional loan. VA coming back in really strong. All of these kinds of things. People, if they don't have 25 offers to pick from, then they don't get to pick every single piece that's the
Right.
the cherry on top. So what are some things, remind us, since it has been a little while since we've worked with them,
Yeah.
remind us some of the things that Primis and some of the others have out there for first-time home buyers. Let's start with them.
Well, I think that THDA is probably the one that, the loan program that's going to see the most usage out of this, because what I've noticed with the volume that I'm seeing and the applications I'm getting, and it could be cyclical, it could just be circumstantial, but I'm seeing more of that first time home buyer who, hey, I've got pretty good credit, I've got a little bit of money, I've got a pretty stable job, but I don't quite have enough money at these prices for my down payment and my closing costs.
Mm-hmm.
So with the THDA, you got a couple different ways you can structure it, whether going through an FHA program or a conventional program. But in essence, they're going to give you some money to help you get to the closing table. And then you're going to pay that money back. It's not free money. It's not money that you get to keep forever. It's not money that if you just stay in the house for 10 years, it's yours, you get to keep it.
Which is what it used to be.
It is. It used to be that way. But now
9 years, I think, right?
Yeah.
Mm-hmm.
And now you're going to pay it back. It's going to add to your monthly payment, but it can help you go ahead and get in the house. And what I'll tell people a lot of times, and this is kind of a conversation that I've had with a lot of people, is if mortgage rates do come down, do you want to be a home buyer in that scenario?
No.
Because it's going to create another feeding frenzy.
Mm-hmm.
You're going to have there's already a lot of pent up people there's demand for homeownership is strong.
Still.
And anyone who bought a house or refinanced in the last 2 years, and they're in the 3s or 4s, maybe low 4s, high 3s, maybe even in the 2s, they're not planning on moving. There's going to have to be a life event to make them give up that mortgage that they have. So those are houses that aren't coming on the market. We know inventory is going to continue to stay tight. So if rates start to fall, I would rather already have my house and be able to take advantage of a refinance and get into the loan structure that I want long term. At that point, then use that as my impetus and my catalyst to get back in the market and try to go buy a house with all of that competition.
That's good advice.
But yeah, so I think we're seeing a lot more interest in the THDA, FHA. It used to be, 8 months ago, if I could approve somebody for an FHA mortgage, I'd send them the letter and I'd say, hey, go out there, find a house. And they just get so frustrated.
Mm-hmm.
You could write 10 offers and just, when you're writing it, unless there's a connection to the property, unless there's some sort of relationship, it was very difficult for that person to get a house under contract. But now you can. So that's that return to normalcy that we've all said we wanted. Right. We all asked for this. And it didn't know that necessarily it was going to look like 7%, right? But we all wanted the market to come back to normal, where you could go out and spend a weekend or two looking at 6 or 7 houses and decide which one you want to write an offer on, and have a realistic chance to get it, regardless of the lending program that you were using. Well,
and I need to throw this caveat out there. It is still 100% advisable that you get, if there's a hierarchy of loan products, if you can, it is still advisable to get the better of the loan products out there, because we are still absolutely seeing multiple offers on properties that have been dressed up and priced correctly.
Right.
Now we're not seeing 25 offers on those properties. We might see 3, or 4. But that absolutely does still happen.
Yeah.
So it is again, talk to that advisor, but it is still in your best interest to get the best possible loan product from a marketing standpoint.
Well, and understand the differences. Like I was working with a client over the weekend, and we can do FHA here, and this is what it's going to look like. And then you start breaking down the upfront financing costs, and you start breaking down the upfront PMI and then the monthly PMI. If you've got really good credit, maybe you don't want to use FHA even. I mean, a lot of people think FHA is for a first time home buyer, but it's not. You can be buying your 10th house and use FHA. But if you've got really great credit, then maybe try to go that route. Maybe put down 3% or 5%, and you can play with the mortgage insurance a little bit more with conventional financing. So just understanding what your options really are.
And from a listing agent standpoint, 3 or 5% conventional still appears to be a better option than an FHA. Well, and right or wrong.
And don't just look at the interest rate.
Mm-hmm.
Look at the costs associated with the mortgage insurance, because this particular client, I was showing him here's your interest rate with FHA, and it was lower than the conventional that I was recommending that he use, and he just kept going back to that interest rate. But this rate is higher. And I was like, yeah, but look at the mortgage insurance cost. Look at what the monthly payment is between the two of them. And then throw in the fact that FHA's got $5,000 in upfront mortgage insurance.
So is that the whole APR?
That plays into APR.
Yeah. So what is APR?
APR is a representation of the amount of financing charges and interest rate all combined.
Okay. So the initial costs to the loan, the closing costs, if you will, put back in there as an addition to the percentage rate.
Some of them, but not all of them. So it gets confusing. So, and the thought process behind APR was compare APRs, that way everybody's on the same playing field. But in some cases, because it's going to take into consideration all the fees that can or that do go in APR, origination points, discount points, or loan application fees, PMI, some of those things that go into the APR. But sometimes what you want to do is just look at the dollar cost of the fees and the interest rate and come up with your game plan.
But is it fair to say that if I have my quoted rate, let's say it's 7.25%, but the APR is 8, right? And then I have another loan and it's the same type of loan and it's at 7.25%, and my APR is, I don't know, 7.5, 7.5.
Yeah.
That we can assume that there is fewer fees associated with that loan.
Yes, I would look at the loan estimate and really dive into the numbers to understand.
Especially if you're comparing this guy's rate to this guy's rate.
Right. I'd want to look at a loan estimate or an itemized fee worksheet or something and understand that until you have a loan estimate that's locked, you don't have anything firm. And in this business, especially with your online lenders, we'll see fee estimates that come out that are just completely off basis. And you know that when it comes down to this client having a house and on a contract and ready to lock, that's not going to be what they get. So that's again where it comes down to having somebody that you can trust, that's going to lead you along with the right information.
Gotcha.
Not just try to give you some lowball estimates until it's too late.
Right. Yeah. Wow you with a low estimate.
Yeah.
All right. I'm gonna skip to my last item, and this is just something I talked about this it's been a couple years ago, and now we're here. Now we're at a time where this can, and I saw it on an MLS sheet the other day, as a matter of fact. Talk to me about assumable mortgages. With rates being where they are, it is something that's very enticing if I've got a mortgage that's assumable to offer that as a marketing piece.
Absolutely. If you can, I mean, let's start with what an assumable mortgage is. So like if you own a home, you bought it with a FHA loan 3 years ago and your rate is 4. You've got a very, very attractive situation here because somebody can come in and assume your mortgage, and that assumes your current balance and it assumes your current interest rate, your current terms. They basically are just going to take over the note.
Take this name off and put this name on.
Right on. So here's the challenge with it. It has to be an FHA loan.
So there are no assumable conventionals.
Correct. It's going to have to be an FHA loan, and your house is appreciated in value from when you acquired it to when you're selling it now. So if you're not going to sell it for what the mortgage balance is, you're going to sell it for current market value. So whoever's going to assume your mortgage needs to be able to cover the gap between your current payoff balance and not the payoff balance, but the current balance on the mortgage and the sales price.
Can you essentially use that? It would be a first position mortgage. It would be the primary mortgage on the home. Can you just get a secondary, a second mortgage or a HELOC or something like that to close the gap? So let's say you've got a $500,000 house. I've got a $200,000 assumable FHA mortgage on my house. So we've got a $300,000 difference. I bring in 80 and I get a HELOC or something for 220, or even a second mortgage or whatever. Is that a way to go about it?
Let's plan on answering this question in the comments. as I don't know for sure, and it could be dependent on the current mortgage holder if they will allow that or not.
Mm-hmm.
So who you're going to apply for this mortgage with is going to be whoever's servicing the mortgage at the time that you're assuming the mortgage, and I would venture to guess that this is just standard answer for FHA that would determine if a second lien is allowed. I don't know the answer to that off the top of my head though.
Gotcha. Well, I know that they will allow a home equity line of credit.
Right.
I mean, we see that all the time.
Yeah.
Right?
So you'd have like a standard purchase with a conventional mortgage where somebody's going to take out an 80% mortgage. They're going to put 10% down and then they're going to get a 10% line of credit. I've done some of that financing.
Mm-hmm.
We've got some great people in our community who can come in and will work with me very well on setting that kind of thing
Getting her done. Interesting. All right, so I'm gonna be looking for the comment answers. So you gotta double check. This is why I like Bryan. Here's what you might not have heard him say is what he actually said is, I don't know the answer to that exactly, but let me check and I'll get back to you.
Hey, I mean that's
important to me.
Yeah.
Right. Don't make stuff up.
Yeah, I'm not gonna do that.
No,
not on record.
No.
Not on camera.
Right.
Every other mortgage lender in town is gonna be watching and be like, that guy's an idiot.
Yeah, maybe over a glass of bourbon when the camera's not rolling, but yeah, that's funny. Cool. All right, what else you got? I saw you brought a table. What are you gonna? Well,
this is just like some numbers, right? So just for example, and say you've got a $424,000 mortgage at 7.25%. The principal and interest payment on that's going to be $2,892. You've got 10,000 or so to work with. You want to buy that down, so you buy the rate to 6.625. It's going to save you $177 a month in payment. But if you wanted to turn around and use that same money to just make a principal payment and put basically more down, then you're going to come out $62 a month better on your payment than would be if you just did nothing and you kept the money. So that gets back to what we were saying earlier. What do you want to do with that $10,000? Do you want to hang on to it? Do you want to keep that liquid in case of a rainy day, or to put a fence on the house, or new curtains or new blinds?
And I think that all comes down to asking the right questions. How long are you going to stay here?
Yeah.
Do you believe rates are going to come down in the next, 2 years, 3 years, whatever?
Yeah.
If you're going to stay here for 3 years, and number one, if you're going to stay here for 3 years, you probably don't ever need to refinance it if your plan is to sell.
Yeah.
Right. So in that case, what is the cost savings and what does it cost me? Right. $170 some odd dollars a month times
to keep your money liquid.
Right. $10,000 divided by 170 some odd dollars. Does it come out to less than 36 months?
And it comes down to, what's your tolerance? If you think, hey, so that the break even on those points is 38 months. So right at 3 years, a little over 3 years. Well, gosh, man, we're 18 months in and I'm going to refinance this house now. Guess what? You still saved $177 for 18 months. So you still made your quality of life a little bit better. You had a little bit more cushion in your monthly budget. For 18 months, you enjoyed the lower payment. And now you're going to refinance it. You didn't quite get to the break even point, but you still can probably feel good about the use of that money.
I'm spending the money on the house.
So the other, what do most people do? That
$170 is gone.
It's gone,
Yeah.
but it's spent on things that make your quality of life better. Hopefully it's,
hopefully
you're not taking that. Nobody's taking that 177 a month and throwing it into I shouldn't say nobody. Some people might, but most people aren't going to take that 177 a month and throw it into an investment account. They're going to use it in their life.
Mm-hmm.
And that's why people say, I'm not comfortable with that payment, because they know there's other things that they want to do.
Mm-hmm.
So if you get that payment down $177 a month, it makes you feel more comfortable with that house.
Mm-hmm.
And then guess what? Hey, maybe you never did get that opportunity to refinance. That opportunity never came, and you're in that house for 10 years, but you've saved a lot of money because you bought that rate down.
So then that goes back to that question. What are you going to do over the next however many years?
Yeah.
And ultimately, how sure are you of that?
Yeah. Yeah.
Yeah. Good stuff. So this is why that is why we run numbers like this right there. That's exactly why. And this is why we have Bryan. I wasn't supposed to do that. Was there notes on there that I wasn't supposed to see?
No, it's all good. Yeah. It's all good. Yeah.
Okay, just making sure he doesn't have Jonathan's a bald idiot on there. That's good. Trent, you got any questions for Bryan?
No, sir. That was very informative. Very well done.
This Week in Real Estate.
This Week in Real Estate, episode 2.
Episode 2.
Fire.
What in the world is this? Trent was like, hey, we need to do something that is pretty much just real estate centric.
What a novel idea.
Is this real estate centric?
I would say so. Very, very, very good information.
Mission accomplished. All right. Anything cool coming up in the
Nailed it.
community? Nailed it. That's it. That's
Sorry.
it.
NaileYourMortgage.com.
That's it. Anything cool
Shameless
coming up in the
plug.
community that you guys want to talk about?
Yeah, Cooking to Build.
It's this weekend, right?
So,
Saturday.
Yeah, come out to the square. For $30, you can get a souvenir bowl and go around and taste. Probably, I don't know how many vendors they have.
Oh
30 or
gosh,
40.
No, at least,
It-
at least.
Yeah, and you'll leave full, even though you're eating 1 or 2 bites of
Soup and chili.
stew, whatever it is at a time.
Cornbread,
You're going to leave
little
full.
tiny grilled cheeses.
and it benefits the Habitat for Humanity. So
Most importantly, it benefits Habitat for Humanity. Our local Habitat organization is awesome.
they really are.
They are awesome. They've got great people working there. They're doing great things in our community. And if you've never educated yourself about that process, if you've never educated yourself, then I guarantee it is not what you think.
100%. It is not a free house.
It
is-
by any stretch of the imagination. Yes, by any measure, it is not a free house. What else is going on? Of course, trick or treating tonight. Trick or treating on the square, right?
Yeah,
assuming the weather's good.
Assuming the weather's good, we'll be in our neighborhood rolling around.
Yep. My buddy Bill Stieber played here on Friday night. Played here at CGB. Man, what a show! That guy, he's awesome.
He can play anything.
He was playing a saw blade.
Yeah.
Like literally, he was using a bow playing
Yeah.
a saw blade. It was awesome.
It's great.
So his house up there, just off of Main Street. If you've never trick or treated at Bill's house, you have missed out.
Is it spooky?
Dude, it's that guy in the Halloween, like the kids' Halloween shows that like way overdoes it and has the brain bucket and has the
Yeah,
eyeball.
yeah.
That's Bill.
Oh
The,
man,
the real life overdoes it guy. It's awesome.
it's great.
Yep. So go by and see him. All right. Trent,
Yes, sir.
appreciate you.
Yeah, man.
Yep.
Appreciate y'all.
Brian,
Thank you, Brian.
always appreciate
Thanks
you,
for
sir.
having me on. I appreciate it.
If you need something mortgage related or just have some questions, give Brian a call. If you need something real estate wise, give me a shout. Talk to you soon.